Good morning. You are watching live daily market outlook for Friday, 16th of March 2012, prepared by Windsor Brokers. At the end of the week shows some corrective action in the markets as the rally in the dollar takes a bit of breather today, as traders booked profits on the recent chunky gains ahead of key resistance levels, but the greenbacks rally was seen intact in line with the brightening U.S. economic outlook. The dollar was lower against yen at approximately 83.50 zone this morning, having retreated from an 11-month peak of 84.19 seen yesterday. And the traders had some selling kicked in after the pair gained 1.2% this week, and as it approached the 2011 high of 85.53. Most of the investors are now taking profits after huge gains this week made, as the last group of hedge funds and other investors went dollar long. It's just a tiny correction in the uptrend, which is likely to carry on at least last year's high, 85.50, possibly towards 86. This is the majority of comments of majority of analysts commenting about recent dollar yen's strength. The Federal Reserve's inflation target drove the Bank of Japan into setting its own 1% price goal in February. The minutes of Bank of Japan meeting showed during the Asian session, with a few policymakers calling for a higher target. Traders focused on the minutes of Bank of Japan's meeting when the central bank surprised by easing policy, because the move was one of several factors that led to subsequent weakness in the Japanese currency. The other important subject that actually this was the news from yesterday, when Britain decided to cooperate with the United States on the release of strategic oil stocks that is expected within months, according to the British sources, in a bid to prevent fuel prices choking economic growth in a U.S. election year. A formal request from the United States to the UK to join forces in the release of oil government-controlled reserves is expected shortly, following yesterday's meeting in Washington between President Obama and Prime Minister Cameron, who discussed the issue. Britain would respond positively to the two sources said, and Cameron said a release was wrong considering. Also, the Cameron said that they didn't make any decision, and this was just to be discussed broadly, as they are looking at this issue carefully. It's as if there is something wrong worth looking at. Short term, they should look at reserves, and yes, he confirmed this. The details of timing, volume, and the duration of a new emergency drawdown have yet to be settled, but a detailed agreement is expected by the summer, according to the sources. This was the reason of yesterday's sharp fall of crude oil prices, when the April NYMEX oil dropped to 103.79 off its previous highs at levels above $106 per barrel. However, the price action recovered quickly, regaining levels above $105 per barrel. Also, today's CPI figures are one of the key releases for today, and they are due at 12:30. And in case the inflation would result higher than expected, as the higher energy costs has three main impacts, which can all be interpreted as negative for the economy. Less chance of Fed easing, less income for discretionary consumer spending and weaker profit margins for producers. The expectation is that the headline inflation might rise to 0.5% in February compared to 0.2% increase in January. With this, we are going to start now with today's calendar that is not quite rich, but has some very important releases due today, starting with the Eurozone trade balance due at 10 o'clock GMT. Expectations are for narrowing the trade surplus to 6.2 billion euros compared to 7.5 billion euros of the previous release. And that basically would be the all from Europe for Friday, 16th of March 2012, while across the ocean, America starts with the CPI release at 12:30 GMT. Forecast is 0.4 to 0.5% compared to 0.2% of the previous month release, while core CPI is expected to stay unchanged at 0.2%. From US, also capacity utilization rate due at 13:15 GMT is expected to show some improvement. 78.9% today's forecast compared to 78.5% of the previous month release, and industrial production at the same time at 13:15 GMT, also improvement by 0.4% compared to unchanged previous release. Preliminary University of Michigan consumer sentiment forecast 75.8 compared to 75.3 of the previous month release. Now we're going to take a look at the currencies and commodities and see the latest movements and expectations for the day. The euro dollar, after sliding down to 130.00 yesterday, is in the near-term recovery mode, with the gains breaking our initial barriers at 130.80, 130.90. Also 131.00 to test the next barrier at 131.20, where the gains were limited for now. The pair currently moves within the narrow sideways range trading, with the downside being held at around 130.60, 70 zone, where are both 20 and 55 days on hourly chart moving averages. The hourly studies hold some positive structure and see room for a further extension higher, with break above 131.20 and 131.50, where is the 90 days moving average on the daily chart, required to improve the currently weakening daily studies and allow for a stronger reversal. Also today's close above 131.20.50 would be good signal for the stronger recovery. Otherwise, we might see just the risk of a lower top and the extension of the broader downtrend of 134.85. As I said, daily studies are weakening, and the pair is currently struggling to regain 55 days moving average that currently stands at 130.86. Back to the lower time frames, hourly studies are still positive, while 4-hour structure is losing traction, as studies still hold below, and the momentum recently broke again below its midlines, seeing more potential towards the downside. Loss of 130.00 handle would risk at retest of our key short-term support at 129.73 and Fibonacci level 61.8% at 129.52 on a break. On the upside, as said, 131.20.50 needs to be cleared, and more significant 131.90 lower top of 13th of March in order to confirm the bottom at 130.00 and allow for a stronger recovery. The cables current price action shows that pair regained some strength after finding support at 156.30 zone yesterday's with break above the main bear trend line of recent highs, and extended gains close to our next very strong barrier double top at 157.45. Currently, the 20 days moving average on the hourly chart underpins the advance as the corrective pullback was contained at 156.93 by 20 days exponential moving average, and the positive studies on the hourly chart see potential for a attack at 157.45 in order to avert immediate downside risk at 156.00 and allow for some stronger recovery, aiming towards next very strong resistance at 158.00, 158.30 zone, with the later one marking the lower top of 8th of March 2012. On the daily outlook, the studies are losing strength as both broke below their midlines, although currently they are rather sideways, rather neutral, but we need to see break above 157.45 in order to show some more positive structure. 55 days moving average currently at 156.80 is holding the downside for now, ahead of 90 days one at 156.50, with loss of these two dynamic supports and the break below 156.33 hourly higher platform to turn immediate risk towards the downside at 156.00, with break below here to risk an extension of the broader downtrend of 159.90 and open 55.23 Fibonacci level and 55.00 as round figure support. Immediate support now lies at 156.90, where it's a broken bear trend line, and while holding above this level, it keeps the focus, near-term focus at the upside. As I mentioned, the hourly studies are still holding some positive tone, but break above 157.45 is required to confirm. Dollar yen enters corrective phase after hitting a fresh high yesterday at 84.17, with losses being so far contained at 83.20 zone, just ahead of 50% retracement of the latest upleg from 81.95 to 84.17. The pair is currently within the narrow range consolidation, moving in the range, moving in the directionless mode, with immediate resistance 83.60 zone, which is the range ceiling. The hourly studies are still in the negative territory, and we need to see break of minimum 83.60, 83.80 in order to improve. The positive currently, the 20 days exponential moving average still holding below the price that gives some support to this. However, on the daily picture, the studies are still very positive, and but at their extreme levels, and this might signal some stronger corrective action, as the stronger uptrend of 76.00 hasn't so far seen any more significant correction, and stronger profit taking that might occur at these levels, as the pair is approaching our next very strong resistance at 85.50 zone, where we have a Fibonacci level, previous yearly high, and 150 days moving average, and some pause in the current strong action might be seen, as I said, no stronger and more significant profit taking seen so far. On the downside, immediate support is yesterday's and overnight's low at 83.20 zone, ahead of 83.06, which marks 50% retracement, with the loss of 82.80, 61.8% retracement, and 82.63 previous high, to more significantly weaken the near-term structure and allow for a stronger correction towards next key support at 82.00. On the upside, as I mentioned earlier, 83.60 and 83.80 needs to be regained in order to refocus 84 and 84.17. That will allow for a further extension higher, with the 84.50 and 85 seen as the next upside target. I need to mention that euphoria about buying dollar yen still exists among the investors and hasn't significantly hasn't weakened so far in significant way that would trigger a stronger pullback. But according to the technicals, the most likely scenario will be further extension higher, as the quite good support was so far found at 83.20. The dollar Swiss near-term price action is in defensive of high of yesterday at 93.33 after the pair regained and cleared the key short-term target at 93.00 with subsequent pullback and now weakening the near-term structure. The latest reversal briefly broke below immediate support, the trend line, bull trend line of 90.70 higher low, and currently hovering around this line, but break below might signal further extension as the latest dip hit 92.00, 50% retracement of the latest 90.70 to 93, pardon, 33 ascend would allow for some stronger correction. So far the pair is still holding below 20 days exponential moving average on the hourly chart, attempting currently and it ahead of 92.43 the 55 days exponential moving average. Break of both is required to improve the current structure and allow for a stronger bounce of 92.00 yesterday's low. Otherwise we might see some stronger easing with the next level coming at 91.81, which is the next the main bull trend line drawn of 89.30 double bottom, and loss of which might risk deeper reversal. 91.70 comes next as 61.8 Fibonacci retracement ahead of 91.40 higher low of 13th of March, loss of which would put the short-term bulls aside in favor of deeper reversal. On the upside, we need to see regain of 92.80-90 zone in order to refocus upside levels and avert immediate downside risk. Gold has seen some positive tone in the near term after hitting a fresh low at 16.34 on the 14th of March, currently holding around 16.54 with the recovery bounce hitting 16.66 high so far, but the broader downtrend of recent high at 17.90 remains still intact as price action holds below 20 days exponential moving average on the 4-hour chart, as well as 16.75, the main bear trend line. We need to see the break of minimum 16.75 in order to ease the current bear pressure ahead of more significant barriers at 17.00 and the 17.16 high of 12th of March. 16.63 previous low has been tested briefly so far, but still unable to break it. And holding below this level as well as 20 days moving average would keep the immediate focus at the downside, as studies are still in the negative territory, but momentum quite extended for now. That might delay the fresh bears. However, the MACD is firmly below its zero line, although pointing higher currently, but still in the negative territory, while RSI on the 4-hour chart started pointing lower and attempting below its 7 days moving average. That might signal further weakness of the yellow metal. Hourly daily structure is firmly in the bearish mode after losing the main bull trend line and the 200 days moving average, and breaking below 1656, 50% retracement, aiming towards 1625, which is a 61.8 Fibonacci retracement of the latest stop leg from 1522 to 1790. At this point, we need to see break above 1680, 90 zone, where are the 200 days moving average and broken trend line, and also regain of minimum 1700 psychological barrier in order to avert immediate downside risk. But currently the current situation keeps the downside more favored for the yellow metal. The crude oil remains in the range trading despite yesterday's spike lower to 103.79, brief break below 104.34 recent range floor, but quick recovery above these levels and above $105 per barrel keeps the price action still in the rather sideways on the short term. However, the tone is still turned towards the downside as the hourly studies are more into negative territory, and the price holding below the moving averages 20 and 55 days on the 4-hour chart. I would say at this point 105.84 and 106.17 moving averages and dynamic resistance need to be cleared ahead of static barrier at 107.33 high of 13th of March in order to improve the near-term structure with further extension above 108, 108.20 to confirm the positive near-term tone of yesterday's low at 103.79. Otherwise, the risk remains at the downside. Initial supports at 104.34 previous low and a more significant 103.79 yesterday's low. That will loss of which would allow for a further easing. The daily studies are losing momentum, but still holding in the positive territory with the loss of 102.50, which marks the 55 days moving average to more significantly weaken the current structure. Also, the main bull trend line of low of 74.94 of 4th of October 2010 comes approximately 2011, pardon, comes approximately at this zone at 102.66, and break here would signal an end of the positive bull phase of 95.43. Basically would enter the next lower level, the range between 103.69 and 97.43 range. That would keep the upside out of reach for now in favor of further easing and further sideways movements. There was a question about I think euro yen, if I'm not mistaken. Was it euro yen? Can you repeat, please, just to confirm? Or it was euro Swiss? I'm not quite sure. Euro yen, okay. We're going to do quickly the euro yen. The near-term structure remains. The hourly studies are rather neutral at this point as the pair hovers just below 109.62, yesterday's high, while hourly structure sees a more positive tone as the price action holds above 108.82 20 days moving average and just ahead of 109.94, a previous high, as it broke above 109 handle. From the larger picture, the positive upside action of 97.02 low of 16th of January cleared the 200 days moving average, and the latest, the last obstacle is at 109.94, 27th of February high. That will open way for a further extension towards 111.55 high of 31st of October 2011. Larger picture still shows the pair in the downtrend as shown in the on the weekly chart, with the good part of the latest down move from 2011 high at 123.35. So far tracing close to 50% at 110.25, would break above 109.94 and the 110.25 to open way for a stronger recovery and static barrier at 111.55 and 113.33, 61.8% Fibonacci retracement. Good luck.